Hello, my name is Yan Chen. Today I'm going to share the topic of foreign exchange market, key players and their rules. My team members are Wang Tingyu and myself. My foreign exchange market is a complex ecosystem with key players, central banks, commercial banks, corporations, and financial institutions, each contributing to its liquidity, stability, and dynamics. Understanding their rules is essential for navigating this evolving landscape. Next is the importance of the foreign exchange market. The foreign exchange market is a global, decentralized marketplace for trading national currencies against one another. For the foreign exchange market is the largest and most liquid financial market in the world, with the daily trading volumes exceeding $6 trillion. It facilitates the exchange of one currency for another, enabling international trade, investment, and financial transactions. The foreign exchange market is of paramount importance to the global economy as it underpins the stability of exchange rates, influences monetary policies, and provides a platform for risk management and speculative opportunities. So, what are the functions of the foreign exchange market? The first is the currency conversion function. Foreign exchange market enables the conversion of one currency into another, facilitating international trade, investment, and tourism. The second is the hedging function. The hedging function of the foreign exchange market protects the value of assets of companies and investors by trading to offset the risk of exchange rate fluctuations. The third function is speculation. Foreign exchange market allows investors and traders to buy and sell currencies to profit from fluctuations in exchange rates. The fourth function is arbitrage. The arbitrage function of the foreign exchange market takes advantage of the exchange rate differences between different markets to buy low and sell high for profit. The foreign exchange market also has a price discovery function. The price discovery function of the foreign exchange market reflects the real market value of the currency through the relationship between supply and demand. The last function is to provide liquidity. Foreign exchange market ensures there is enough liquidity for businesses, governments, and investors to buy and sell currencies at a stable price, supporting international economic activities and financial stability. The regulation of national monetary policy, maintaining the stability of exchange rate and promoting the stable development of a country's economy are all inseparable from the intervention of the central bank. So, how do central banks perform these roles in the foreign exchange market? The first is interest rate policy. Interest rate policy directly impacts the currency's supply and demand, influencing exchange rates and the overall liquidity in the market. Next is the foreign exchange reserve management. Reserve management provides a buffer against the exchange rate volatility and enhances the country's resilience to economic uncertainty. Next is the direct foreign exchange intervention. This intervention can be effective in the short term for managing sudden or excessive volatility that may require substantial foreign reserves. In addition, the central bank can be also influence the foreign exchange market through economic regulation and market monitoring. Next is commercial banks. Commercial banks play a central role in the foreign exchange market, acting as the primary participants and facilitators for various transactions that drive global currency exchange. Their role in the foreign exchange market can be understood across several functions. First is liquidity providers. Commercial banks are the primary liquidity providers in the foreign exchange market. Large commercial banks such as JP Morgan Chase, Citibank, and HSBC act as market makers in the foreign exchange market. This means they could buy and sell prices for currency pairs, thereby providing liquidity to the market. The second function is currency conversion. Commercial banks offer currency conversion service to individuals and businesses, allowing them to exchange one currency for another. This is essential for facilitating international trade, travel, and investor activities. The last function is risk management. Commercial banks manage exchange rate risks through forward transactions, swaps, and other tools to ensure the stability of foreign exchange transactions. The second half will be explained by my partner.
Okay, starting with forex brokers. Forex brokers serve as the intermediaries that provide essential access to foreign exchange markets, enabling clients to trade through advanced platforms equipped with real-time data, analytical tools, and transaction execution capitals. Brokers also support clients through educational resources and market analysis, helping traders make well-informed decisions. This supportive role is increasingly vital, given the wide range of participants from novice traders to seasoned professionals. Additionally, brokers ensure regulatory compliance, which foster a transparent trading environment, protecting client interests, and upholds market integrity. Seen to multinational corporations significantly impact the forex market by conducting large-scale currency transactions to support their trade and investment activities, thereby enhancing market liquidity. These substantial competitor movements can influence exchange rates and affect market stability, showcasing the scale at which these corporations operate and their indirect power to impact currency values. Additionally, MCs utilize financial derivatives such as futures and options to manage currency risk and make strategic decisions informed by exchange rate trends, guiding their international investments. Now let's discuss another financial institutions, hedge funds, asset managers, and insurance companies each play unique roles in the forex market. Hedge funds are known for their speculative trading, which can introduce both volatility and liquidity, often acting as catalysts for significant price movements, especially during periods of economic uncertainty. Asset managers contribute to overall market stability by engaging in trade aimed to portfolio diversification. Insurance companies participants in hedging currency risk, which helps stabilize the markets where they operate, particularly in regions where they hold substantial assets. Regulatory oversight is critical for market stability. Regulatory bodies like central banks enforce the rules to prevent manipulation and ensure market transparency. They engage in market surveillance to monitor trade activities, the vigilance is critical as the forex markets decentralized nature could otherwise lead to unchecked practice. And the sanctions are applied to validators to maintain ethical standards, creating a trustworthy trading environment. Let's move to forex trading instruments, major currency pairs, exotic currencies, and derivatives. Major currency pairs like EUR/USD are highly liquid due to their lower volatility and higher trade volumes. They are performed by large institutional investors, while exotic currencies pressed higher volatility and risk. They can yield substantial rates, but pose greater risks, attracting traders with a high risk tolerance. Derivatives like futures, options, and swaps allow for hedging and speculation, helping traders manage currency exposure. Finally, the future of foreign lands, the technical advancements like algorithmic trading and blockchain, which increasing infection and security. Globalization bring emerging markets into play, aiding growth and complexity. Regulatory harmonization and sustainable plastics are becoming essential, enabling forex trading with responsible practice, especially around the cybersecurity concerns. In conclusion, the forex markets is a complex network wherein participants from central banks to MNCs plays a key role in market stability. As globalization and the technological drive change, understanding these player interactions is essential. Even if some points were missed, remember that each entity in the forex markets is critical for maintaining its integrity and excellence. In essence, understanding the roles and the integrations of these key players is crucial for navigating this intricate market, whether driven by risk management, liquidity prevention, or regulation. Each activity contributes to a more resilient and interconnected financial landscape. Even if some details were missed, the takeaway is clear. The forex market's complexity requires each participant to act responsibly, ensure stability and integrity for all involved. Okay, that's all.